Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover several questions from Chapter 8, Depreciation and Sale of Business Property from Income Tax Fundamentals 2024. So we'll jump right into our first problem, and here it states, on June 17th, 2023, Travis purchased a passenger automobile at a cost of $58,000. The automobile is used 90% for qualified business use and 10% for personal purposes. They've also provided us with the depreciation table, which we have open in another tab, and they also provided the annual automobile depreciation limits. The question is asking to calculate the depreciation expense with bonus depreciation for the automobile for 2023, 2024, and 2025, assuming the half-year convention and no Section 179. So as we see here, we have the Excel already open and we have some notes, some key things as we consider depreciation. So one thing that we need to know about depreciation is also referred to as capitalization. What that simply means is that, let's say, business, they purchase a piece of equipment and they pay $5,000 for this equipment. Generally, you cannot write off the entire $5,000 in the year of purchase. Instead, the cost of the equipment, the cost of the asset, whatever it is, whether it's equipment or maybe it's machinery, maybe it's a vehicle, generally it is not fully written off in the year of purchase. It is not expensed. Instead, it is capitalized, and capitalization is essentially synonymous with depreciation, which simply means that we allocate the cost of the asset over its estimated useful life. So under MACRS, and MACRS stands for the Modified Accelerated Cost Recovery System. So under MACRS, and again, key thing to keep in mind is that there are some differences between book depreciation, which is governed by GAAP, generally accounting principles, generally accepted accounting principles, and tax depreciation. So under MACRS, again, Modified Accelerated Cost Recovery System, taxpayers calculate depreciation using a table which contains a percentage rate for each year of the property's recovery period. The yearly rate is applied to the cost of the asset, and the cost of the property to which the rate is applied is not reduced for prior year depreciation. And in this, we're learning about, bonus depreciation. Here it's saying, in addition to the limitations on the depreciation of passenger automobiles imposed by what's called the listed property rules, the depreciation of passenger automobiles is subjected to additional limitations, commonly referred to as the luxury automobile limitation. So we're going to jump right in. And here, again, we know how much we paid for the asset. Here it's letting us know that we paid $58,000 for the asset. So we need to factor in, well, we'll start off with the first year. Here we see in 2023, we have all the information we need for the most part. We know that the cost of the asset is $58,000. The problem gave us that information. And the problem also lets us know that the automobile is used 90% for business purposes. One key thing to keep in mind is that when you are working on depreciation with a client, you need to ask them, is this asset being used 100% for business purposes, or is it also being used for personal purposes? Reason being, Uncle Sam don't play that, okay? If you are not utilizing an asset 100% for the business, you cannot claim, you cannot fully, capitalize or depreciate 100% of the cost of that asset because it's not used 100% for business purposes. So we have the original cost, $58,000. The business use percentage is 90%. So therefore, we want to determine the amount that is eligible for depreciation. So $58,000 multiplied by 90%, that lets us know that the amount that is going to be eligible for depreciation is $52,500. And just as a heads up, this isn't going to change, right? This stays the same. The problem doesn't let us know anything about the business usage and the personal usage changing over time. So we assume that it's consistent. So for 2024, 2025, that information stays the same. The original cost was $58,000. It's being used 90% for business. So the amount eligible for depreciation, the amount eligible to be allocated over the recovery period is $52,200. So now here we see what the step is asking us, the adjustment for prior year bonus. So it's letting us know that he purchased the item June 17, 2023. So therefore, there's no prior year bonus. There's nothing that we essentially need to account for. So therefore, here we get the depreciable basis, right? Because this is the maximum depreciation that's eligible, but we need to factor in, hey, what was depreciation claimed in the prior year? So in such case, 52,200 minus 0 gives us the depreciable basis of the 52,500. So just to make this a little, more understandable, the original cost times the business uses percentage and the amount eligible for depreciation less the adjustment for the prior year bonus. All right. So with that being said, now we move on to bonus depreciation. So in the problem, it does let us know to calculate the depreciation expense with bonus depreciation. So with the bonus depreciation, that is essentially where sometimes, imagine if there was just this strict rule that individuals can never write off, a majority of it. People, businesses will be more, apprehensive to want to even purchase property because let's say you purchase equipment and it costs like $100,000 and the company has to write it off over 10 years, 7 years, whatever it is. That can be a bit of a nuance. So we have what's called bonus depreciation. So because the cost recovery of long-lived assets occur over many years, there's one way to help lower the after-tax cost of capitalized expenditures. It's through accelerated depreciation. And in addition, sometimes the tax law provides for what's called bonus depreciation. And in that case, that's essentially when businesses are allowed an immediate deduction of all or some of the cost of otherwise slowly depreciated property. So with the Tax Cuts and Jobs Act, it did help to increase the bonus depreciation percentage to 100% for qualified property that were acquired and placed in service after September 2017 through December 31st, 2022. But then there's a phase out from years 2023 to 2027. But again, that helps because businesses, they not just factor in the cost of the asset, but they also want to factor in what is the after-tax cost. So in that case, bonus depreciation for 2023 is 80% because again, remember, there were some changes with the Tax Cuts and Jobs Act. So from September 27, 2017 through December 31st, 2022, bonus depreciation was 100%. However, 2023, it's 80%, 2024, 60%, etc. So in order to calculate the bonus depreciation, you would calculate it as follows. The depreciable basis times the bonus depreciation, the maximum of 80%. But now we need to factor in, there are some annual depreciation limits, some things that we need to consider. So here we look at the table. And with this table here, we're seeing, so the 2023 limits with bonus. So as far as the charts we're going to use, we're going to access the annual automobile depreciation limits. So that's the first thing we're going to consider. So here it's letting us know that, all right, based on, the calculation, the bonus depreciation will be 80%. However, we need to factor in what is the annual depreciation limit. So based on the IRS, automobile depreciation limits in 2023, because we are considering the bonus, the maximum amount for year one is 20,200, but we know we don't use it 100% for business purposes. We only use it 90%. So therefore, the adjusted annual limit is as follows: 20,200 times the 90%. So therefore, we would take the lower of the two, lower of the adjusted annual limit, or the bonus depreciation or MACRS depreciation. So what I'll do, I'll highlight these so that way we kind of know which numbers we're using. It's either the bonus depreciation the MACRS depreciation, which we're going to use the next chart after this, or the adjusted annual limit. So I'll just put these in green or light green, right? So in this case, the amount of cost recovery that we would claim for the first year is $18,180. The amount that we are going to use, I'm going to make this yellow. So for 2023, 18,180. So now we move on to 2024. In 2024, we already know, the original cost is 58,000. The business use percentage, we factored that in already. But now we need to factor in the adjustment for the prior year bonus. So in 2023, the prior year bonus that was claimed was $18,180. So $18,180. So now we need to figure out, hey, what's the new depreciable basis? So the amount that was originally eligible for depreciation minus the prior depreciation that was taken, the bonus. So therefore, the depreciable basis in such case is going to be $34,020. So keep in mind the bonus depreciation that is generally in the first year, the year of purchase. So we don't factor in bonus depreciation. However, what we now need to factor in as well, what's the depreciation factor? So we utilize our chart, and generally, as it relates to automobiles are generally considered 5-year property. So year 1, 20%, year 2, 32%, year 3, 19.20%, year 4 and 5, 11.52, and year 6, 5.76. And the reason being is because it generally factors in that the automobile is being placed in service using, the various conventions that are available. So a portion in the first year and then a portion in the last year or the year of disposition. So in such case, we factor in the depreciation factor. It lets us know here it's 32%, so 0.32. Now we need to determine, well, what is the MACRS depreciation? So the MACRS depreciation is the depreciable basis of 34,020 multiplied by the depreciation factor. So our MACRS depreciation would be $10,886. Now, again, IRS has certain rules. The maximum amount of depreciation, the maximum limit with the bonus is $19,500. So even though the maximum amount is $19,500, we know, hey, we're only using the automobile 90% for business purposes. So the adjusted annual limit would be the annual depreciation limit times the business use percentage of 90%. And that gives us an adjusted annual limit of $17,550. And in such case, we are going to take the lower of the two. So in such case, here we are. We see that the depreciation is going to be $10,886. So this brings us to our next year, 2025. So for 2025, again, we know our depreciation, but again, we have to factor in for the prior year bonus. So our depreciable basis is always going to be reduced when we claimed prior year bonus. So the original amount eligible for depreciation minus the prior year bonus that was taken in the first year. So that gives us depreciable basis of $34,020. So we do the same thing that we did for 2024. We go to the depreciation table. This is the third year. So the depreciation factor would be 19.2%. So in order to calculate the MACRS depreciation, it's our depreciable basis multiplied by the depreciation factor. So that gives us $6,532 MACRS depreciation. Now we factor in, all right, year 3, what would the annual limitation be? We see on the chart, it's 11,700. We know we are only using the automobile 90% for business purposes. So we multiply the annual depreciation limit by the business use percentage, and that gives us $10,530. But again, we are comparing the lesser of the MACRS depreciation or the adjusted annual limit. So therefore, based on this, we are taking the lesser of the two, the $6,530. $132. So the great thing is that obviously in the profession, you will be using a tax software, and the tax software is going to factor in all of this information. But for tax planning purposes, you definitely want to be able to, walk a client through how purchasing an automobile would have an impact, not just for the current year, but also for the future years, because again, they want to know what is the after-tax cost of these capitalized expenditures. So that brings us to the end of our first question. This question asks, when a taxpayer capitalizes an expenditure, the amount is generally placed on the balance sheet, awaiting time or some future event for recognition as an expense. The taxpayer pays for it with debt or liability. The cost can be covered only when the item is sold. The amount is expensed immediately in accordance with ordinary and necessary deduction rules. So based on all of these answer choices, A seems to be the correct answer. And we'll go through the others. The taxpayer pays for it with debt or a liability. This is incorrect. Why? Because an individual can purchase an asset using cash. It doesn't necessarily need to be a liability. They can pay for it using cash. The cost can be recovered only when the item is sold. That is not true. Obviously, when they capitalize the expenditure, maybe they can take bonus depreciation, right? Section 179 with these additions to the modified accelerated recovery system, they can also have the opportunity to also expense it where they otherwise normally would capitalize it over a period of time. D states the amount is expensed immediately in accordance with ordinary and necessary rules. So ordinary and necessary deductions, expenses, this is governed by Section 162, but no, this would be an example of like Section 179 or bonus depreciation, which is obviously the opposite of capitalizing an expenditure where depreciation is being claimed. So the correct answer is A. The amount is generally placed on a balance sheet awaiting time or some future event for recognition as an expense, because a capitalized cost is not deducted until later. All right, here we have this question, and it asks us, what is the maximum amount that Kelly may deduct for 2023 under the election to expense, assuming she elects to expense the entire $24,000 purchase? So as part of the Landmark Tax Reform Act of 1986, Code Section 179 was implemented. And with this section, it basically helped to decrease the cost of investments for business property. And what it essentially did is that it allowed these small businesses to expense the cost of certain properties that would otherwise need to be capitalized and depreciated over a period of time. Because again, some businesses that will decide, hey, what's the point, because obviously, let's say a business, they're paying cash of 50,000 for a property, or maybe they are taking out debt, but if it's going to take them a long time to really get the benefit, as it relates to the cost recovery, what's the point? But with this incentive in place, bonus depreciation in Section 179, which we're covering in this question, this encourages businesses to purchase assets. So under this Section 179, taxpayers, they have the opportunity to elect to expense the acquisition cost of certain property subjected to certain limitations. Because again, the cost we know would otherwise be deducted over a period of time using the depreciation factors, the depreciation tables that we just saw. But with this Section 179, they get the opportunity to, write off a portion of it. So with this problem, it says on July 20th, 2023, Kelly purchases office equipment at a cost of $24,000. Kelly elects out of bonus depreciation, but makes the election to expense for 2023. She is self-employed as an attorney, and in 2023, her business has net income of $6,000 before considering this election to expense. What is the maximum amount that Kelly may deduct for 2023? So as it relates to Section 179, it places 3 limitations on the expensing election. The first is a maximum on the annual amount that can be expensed. 2, there's a phase out of the annual amount limit. And 3, there's what's called a taxable income limit. So originally, the maximum annual expensing amount was $10,000. But over the years, obviously, things have changed. Fast forward all the way to 2023, the maximum amount that can be expensed is $1,160,000. So obviously, there are a lot of changes, and the maximum has increased a great deal as it relates to the phase out. So the annual maximum expense amount is reduced dollar for dollar by the amount of Section 179 property acquired during the year in excess of a threshold amount. And for 2023, that threshold was $2,890,000. So in the event that, let's say, a taxpayer, they place in service $4,050,000 or more, then unfortunately, they can't expense all of it in Section 179. And that last limitation is mentioned is the taxable income limit. So the amount of acquired qualified property that can be expensed annually, it's limited to the taxpayer's taxable income before they consider any amount that's going to be expensed under Section 179 from the trade or business. So in this problem, it lets us know that the net income was $6,000. So therefore, unfortunately for Kelly, yes, she pays $24,000 for the equipment, but unfortunately, her net income is $6,000. So therefore, $6,000 is the maximum that can be deducted. And again, you got to think about it from a logical perspective. What a lot of taxpayers will probably do is they'll say, hey, you know what? Especially if the taxpayer also has, let's say, like a W-2 job, they would create artificial losses. Well, not artificial, but they can reduce their tax liability, right? So let's say in this case with Kelly, if they didn't have this provision in the tax law, she would have an $18,000 loss, right? And assuming, let's say she had another job or maybe another business that had profit or a higher profit, her tax liability is going to be lower because her tax income is lower because of the loss. Uncle Sam don't play that. So therefore, unfortunately, as it relates to Section 179, it cannot create a loss. The maximum amount that can be claimed is your income. So therefore, the income from Crelly would go to 0, but not below. So this brings us to our next question. Here it states, and we should know this, which of the following is not considered a limit on the immediate expensing election of Section 179 in 2023? So we just discussed this from the previous problem. The total Section 179 eligible property acquired in excess of $4,050,000. So correct. That is considered a limitation, as we just mentioned, because once the amount of property contributed exceeds the threshold, in such case, because it's reduced on a dollar for dollar basis, if that amount exceeds $4,050,000, none of the property can be expensed. B is correct. There is an annual limit of $1,160,000. C states 50% of qualified improvement property. Doesn't seem correct, but we'll look at D. The taxable income of the taxpayer considering all income and deductions except for Section 179 immediate expenses. E, none of these choices are correct. E is incorrect because A, B, and D are correct. So we know E is incorrect, and that leaves us with C, 50% of qualified improvement property. That is not correct. So C is the correct/incorrect answer. And as mentioned, there are 3 limitations on 169. There's a maximum on the annual amount expensed. There's a phase out of the annual amount limit, and there's the taxable income limit. This one asks us about listed property, and it states, which of the following is a true statement about depreciation on listed property? So as it relates to listed property, Congress feel like, some people, they were using the favorable tax incentives of accelerated cost recovery system and the limited expansion election to claim depreciation deductions on assets that's also used for personal purposes. And we know what? Uncle Sam don't play that. So essentially what happened, in order to, take or to deter rather this abuse of the tax system, Congress has these special rules that apply to depreciation of what's called listed property. And listed property, that's basically assets that can be also used for personal use pretty much. So this includes like automobiles, equipment. Sometimes it can be used for both business and personal uses. Other property used as means of a transportation, so maybe a truck, a bus, a boat, motorcycles, and things of that nature, or property that's generally used for entertainment, recreation, amusement, etc. So if the listed property is used 50% or less in a qualified business, any depreciation deduction needs to be calculated using straight line. So Uncle Sam, put in place, there are some nuances around these assets used in business that can also be used for personal purposes, which are referred to as listed property. So here it states, A, all listed property is not depreciable and any costs are recovered when the property is sold. So it doesn't seem correct. B, listed property includes school buses and tractors. All right. If listed property is used less than 50% for business purposes, depreciation must be straight line. Okay, that seems like a true statement. Cell phones and computers generally meet the definition of listed property. So let's start at the first one. A, why is that incorrect? So all listed property is not depreciable and any costs are recovered when the property is sold. So that is not true, right? Certain listed properties, they are depreciable, but as we know, it depends on the business usage percentage because there might be a limitation. Here it says listed property includes school buses and tractors. Something to keep in mind is that other property used as a means of transportation, as mentioned previously, trucks, buses, boats, etc., but except vehicles that are not likely to be used for personal uses. A school bus, probably won't use that for personal use. Tractor, probably won't use that for personal use. So B is incorrect. Listed property would not be considered for school buses and tractors because what are the odds that you're using these for personal use, right? Not really likely. C is the correct answer, and we'll look at D. So D states cell phones and computers are generally, both meet the definition of listed property. So again, generally, no, it really ultimately all depends. So there are some things that you really need to factor in, and the best answer choice is going to be C in this case. All right, and one more thing I would like to say about D. Some individuals, they'll have two cell phones, like, Kevin Gates songs, two phones. Computers, generally, some individuals, they'll buy a specific computer just for business purposes and a specific phone just for business. So it doesn't necessarily meet the definition of listed property. Ultimately depends, but it can. So just keep that in mind. This brings us to our next question. We are looking at Section 1231, gains and losses and depreciation recapture. So here it asks us, what is the amount and nature of Derica's gain as a result of the sale of the machine? In 2023, Derica sells a machine used in her business for $24,000. The machine was purchased on May 1st, 2019, at a cost of $21,000. Derica had deducted depreciation on the machine of $5,000. Derica has no previous Section 1231 gains or losses. What is the amount and nature of Derica's gain as a result of the sale of the machine? Congress enacted these depreciation recapture provisions to basically to deter taxpayers from converting ordinary income into capital gains. How would they do that? Ordinary income, or first we'll start off with what's the difference between the two. So ordinary income is going to be subjected to ordinary tax rates versus capital gains, which would be subjected to 0%, 10%, or 0%, 15%, or 20%, depending on the taxpayer's income, right? So Uncle Sam don't play that. He's like, no, not happening. So with these depreciation recapture provisions, by claiming the maximum depreciation deductions over the life of the asset, and then what will happen is they would want to sell the asset and receive capital gain treatment on the result of the gain at the sale. Not happening. So there are three major depreciation recapture provisions. The first, Section 1245, which generally applies to personal property. Two, Section 1250, which applies to real estate. And three, unrecaptured depreciation, which was previously taken on real estate. So as we look at this example here, we're trying to determine, okay, what is going to happen in Derica's case? How will we figure it out? So here we know that sorry about that. All right, so here we see, use it in the business, sold it rather for $24,000. Now we need to determine, okay, what is going to happen? How do we determine how much needs to be considered, recaptured property? So in such case, we would account for it as follows. Let's get our calculator. So here we see that she has deducted depreciation on a machine of $5,000. So what the rules essentially say is that when the item is being sold, the depreciation recapture, and in this case is section 1245, the section 1245 recapture is defined as the total depreciation claimed on this property. And in this case, we see that the depreciation on the machine was $5,000. So $5,000 is going to be treated as ordinary income. The next thing we need to factor in is, okay, well, what is the amount that's going to be treated as section 1231 gain? So in order for us to figure that out, she purchased the property for $21,000 and the depreciation claim was $5,000. So therefore, based on this information, $16,000 represents the basis. So $24,000 is how much she sold it for. The basis is $16,000. So there's an $8,000 gain. Of this $8,000 gain, $5,000 is going to be treated as ordinary income because this is the amount that was claimed for depreciation, and the excess $3,000 is going to be treated as the section 1231 gain. So just, I'm going to go through this again quickly. Again, the business was sold for $24,000. The machine was purchased May 19th for $21,000. So she originally paid $21,000 for the machine, claimed depreciation of $5,000. So therefore, the adjusted basis of the machine was $16,000. Sold it for $24,000. The adjusted basis was $16,000. So therefore, there was a gain of $8,000. Of this $8,000 gain, because of the depreciation recapture rules and the fact that she claimed depreciation of $5,000, $5,000 is going to be treated as ordinary income, and the additional $3,000 is going to be treated as section 1231 gain. So B is our correct answer. All right, this brings us to our next question, fairly similar. Here it says, what is the amount and nature of Paul's gain on the sale of the rental property? So here it states, during 2023, Paul, an individual taxpayer, sells residential real property for $180,000, which he acquired in 2015 for $160,000. Paul has claimed straight-line depreciation on the building of $50,000. What is the amount and nature of Paul's gain on the sale of the rental property? So let's factor in All right, the amount realized. So he acquired the property. We know how much he sold it for. He sold it for 180,000. He acquired it for 160,000. So 160,000 minus the depreciation claimed of 50,000. So the basis is 110,000. The adjusted basis, rather. So 180,000 minus 110,000, that lets us know that there's a gain of 70,000. But again, because of the rules, it's going to be treated differently. In this case, we are dealing with real estate. So because we're dealing with real estate, we need to factor in the unrecaptured depreciation. And the unrecaptured depreciation, in such case. So here we see, of the 70,000, $50,000 is essentially going to be the unrecaptured depreciation. And the excess amount, which is the 20,000, that amount is going to be treated as Section 1231 gain. So again, the main reason why Congress put this into place is because they want to make sure that individuals are not taking advantage of it. And just to ensure that you guys understand Section 1231, Section 1231, this is essentially used to describe property that's used in a trade or business held for more than 1 year. So depreciation recapture is commonly referred to as Section 1245 or 1250. Section 1231, one key thing to keep in mind, it's not capital assets, which we've covered in chapter 4, but they're given special treatment. So gains on Section 1231, they'll be treated as long-term capital gains, while some losses, sometimes they're treated as ordinary losses. So some of these Section 1231 assets, they'll include depreciable or real property used in a trade or business, timber, coal, domestic iron ore, livestock, unharvested crops. So in the previous example, there was a machinery, equipment, and in this example, we see that there is real property. So we're focusing in on Section 1231. And that's how we got our answer. I'll just do a quick run through again to ensure you understand. The building was purchased for 160,000. Depreciation in the amount of 50,000 was claimed. So that gives us an adjusted basis of 110,000. The property was sold for 180,000 minus the adjusted basis of 110,000. There's a gain of 70,000. We need to figure out, how much is going to be treated as unrecaptured depreciation and how much is going to be factored in as Section 1231. So in this case, we factor in the 50,000, which will be treated as the unrecaptured depreciation, and 20,000 will be treated as the Section 1231 gain. Now here we are for this next question. And it's asking us to calculate Holly's total depreciation deduction for the apartment for 2023 using MACRS and assuming she does not elect out a bonus depreciation. And B, calculate Holly's total depreciation deduction for the apartment for 2024 using MACRS. And it states on June 8, 2023, Holly purchased a residential apartment building. The cost basis assigned to the building is $650,000. Holly also owns another residential apartment building that she purchased on October 15th, 2023 with a cost basis of $400,000. All right, so we have an Excel that we will utilize. All right, so here we have some notes that we will go through. So as it relates to real estate that was acquired after 1986, MACRS requires that the property needs to be depreciated using a straight line method. As it relates to the straight line MACRS tables for residential realty, for example, an apartment building, Depreciation is 27 and a half years. However, for non-residential realty, for example, an office building is depreciated over 39 years. But in the event that, let's say, that property was purchased before May 13th, 1993, then it's depreciated over 31 and a half years. For the depreciation of real property under MACRS, a mid-month convention replaces the half-year convention. Real estate is treated as placed in service in the middle of the month of acquisition. Likewise, a disposition during the month is treated as occurring on the midpoint of such month. So let's say it is July 3rd, I purchased an asset for business. Based on the mid-month convention, that asset would be placed in service for MACRS purposes as of July 15th. Or let's say I purchased the equipment on, let's just say November 7th or November 8th. It'll be depreciated as though it was purchased on November 15th. So mid-month, keep that in mind. So we move on to A. Part A is asking us to calculate Hadi's total depreciation and deduction using MACRS and assuming she does not elect out of the annual bonus. So here we have our depreciation tables, and this is the 27 and a half year residential real property. So based on A, we would factor it in as follows. So building 1's cost is 650,000. Building 2's cost is 400,000. So 650,000, 400,000. Next, we need to factor in the percentage. So for building 1, building 1, we see that it was purchased June 8th. June is the 6th month of the year. And building 2 was purchased October 15th, the 10th month of the year. So therefore, the 6th month of the year, the percentage is 1.970. And for the 10th month, the percentage is 0.758. So therefore, 650,000 times 1.97. All right, I have to fix these zeros. All right, so we have 0.0197, and that would give us depreciation for building 1. For building 1 of $12,805. And then we look for building 2. Here we see that, again, this is the 10th year. Now we're going to need to add some zeros for this one. Of 3,032. So just keep that in mind. We do need to factor in the zeros based on the applicable percentage. And then maybe what I should do is actually turn this into a percentage so it's a bit easier. All right, and I think that'll be a bit easier. So the issue before was that I didn't have it. I tried to manually input it as such. So if you're using Excel, I would strongly suggest that you format it based on a percentage. So that way, it accurately mimics it. If not, you need to input the additional zeros pretty much to, get the answer to match the percentage, because obviously you need to convert the decimal into the percentage. So just something to keep in mind. So if you were to, all right, so if you divide it by 100%, you would get 0.000197. Same thing for the 7.58. If you divide it by 100, and you would see you need to add 4 zeros. So just something to keep in mind. So that's why I had to, change it from before. So just keep that in mind. All right, so in such case, the total depreciation deduction will be 12,805 for building 1, plus the amount for building 2. So the total depreciation deduction, assuming that she does not elect out of the bonus depreciation, will be $15,837. Now for B, it asks us to calculate Holly's total depreciation deduction for the apartments for 2024 using MACRS. So if we're using MACRS, now here we see we need to factor in the information, utilizing again, we know when the property was purchased. And if we're using MACRS, this is the straight line, so we need the MACRS tables. I will go back to the first problem to get the MACRS tables. Let's see. And this one just on as 20. All right, perfect. So here we are. So with this one, now it's asking us, with MACRS. And then for the first part of the problem, it's asking us to calculate the depreciation, as we see here, for 2023. And now for this year, we're factoring in 2024 using the MACRS. So same chart, but again, in year 6, or it was put in place in June, the first building, and in October, the second building. So we see here, we know the cost for building 1 is 650,000, and building 2 is 400,000. And then here we see the percentage for year 2 property. So here we see recovery period years 2 to 18. So being placed in service, for year 2, with the exception of, no matter which month it was put into service, it's always going to be 3.636. So again, to avoid having the problem we did earlier, I formatted it to percentage. So 3.636, 3.636. And we multiply it. So 650,000 times the percentage. It gives us 23,634. And then we do the same thing for building 2. And that gives us 14,544. We add the 2. And that gives us $38,178. All right, so again, this is for the first year, 2023. And then for this example, it's asking us for 2024, the second year. So as we're dealing with, the property once it's through years 2 through 18, things become a little easier. Why? Because as we can see here, the depreciation factors for each year are fairly the same. It's not until you get to the last 2 years in the first year where you see that there are differences as it relates to the rate. All right. So A was 15,837. Again, The first property was placed in service in June, so that is why we multiplied it by 1.970. The second building was put in place in October, which is why we use 0.758. And for the second year, we see that it doesn't matter if it was placed in service in January, February, December, doesn't matter. It's always going to be multiplied by 3.636 for years 2 through 18. Hence, we calculated the total depreciation for 2023 and 2024. This brings us to our next question. And here in this question, it asks, calculate Khan's maximum depreciation deduction for 2023, assuming he uses the automobile 100% in his business. So it states, during 2023, Khan purchases the following capital assets for use in his catering business. There's a new passenger automobile purchased September 30th for $66,000 and baking equipment purchased June 30th for $10,000. Assume that Khan decides to use the election to expense on the baking equipment and has adequate taxable income to cover the deduction, but not on the automobile. And he also uses the MACRS accelerated method to calculate depreciation, but elects out of bonus. So there's some key things we need to, keep in mind here. So under Internal Revenue Code, Section 179, we know that there are some limitations. There are 3 limitations. The first is the maximum on the amount expensed. The maximum amount is $1,160,000. That limit doesn't really, come into play here because we see that in total, there was only $76,000 for the passenger automobile and the baking equipment combined. The second is the phase out of the annual amount limit. Again, not a lot of assets purchased, so that $4,050,000 limit is not going to be reached. And then we have the taxable income limit. So based on this case, we see that for Khan, he obviously wants to, take full advantage. Here we see with the MACRS accelerated method, but he doesn't want to take advantage of the bonus depreciation. So in order to answer this question, we click on the depreciation, and we also factor in the annual automobile depreciation limit. So 2023 limits with the bonus and 2023 limits without. And the problem lets us know that he doesn't want to, take advantage of the bonus. So based on this, in order for us to determine how much is going to be deducted, so the election to expense, he wants to claim the full $10,000. So whenever you see election to expense, that refers to Section 179, and it says that he has adequate taxable income. So the first limitation doesn't apply, doesn't meet that $1,160,000. The second, the phase out does not apply because he didn't place more than $4,050,000. And the taxable income limit does not apply because the problem says that he has adequate taxable income. So this full $10,000 is going to be expensed with the election to expense, which is Section 179. But we need to factor in this new passenger automobile, right? So with the regular depreciation, again, we know automobiles are generally 5 years. So the 5 years will be 20%. And I'll get my calculator. So 66,000 times 20% will be 13,200. However, the annual automobile depreciation limits 2023 without bonus is 12,200. So therefore, for this new passenger automobile, the maximum amount that Khan could claim is 12,200. This is the maximum. So in such case, the total depreciation he could claim is the 10,000, the baking equipment, which he is utilizing Section 179, plus the maximum amount of 2023 limits without bonus for the annual automobile depreciation limitation. So we add the two. The maximum depreciation that Khan can claim is $2,200. All right, this brings us to our next question. Here it states, On February 2nd, 2023, Kiko purchases a personal computer. The computer costs $2,400. Kiko uses the computer 75% of the time in her accounting business and the remaining 25% of the time for various personal uses. Calculate Kiko's maximum depreciation deduction for 2023 for the computer, assuming half-year convention, and she does not use the bonus depreciation or make the election to expense. So there's no Section 179. There's no bonus depreciation. So based on this, we need to use the MACRS table. So here we see you have the depreciation table open. And we ultimately need to determine, hey, what kind of property is this? So equipment, computer is generally 5-year property. So 5-year property, we know in the first year, it is going to be 20%. So here we see, they let us know how much the computer cost was $2,400. So we would factor it in as follows. 2,400 times 20% will give us 480. But then the problem also lets us know that for business purposes, she only uses it 75%. So therefore, 480 times 75%. So I'll do that again. 2,400 times the first year factor for 5-year property, which is where equipment falls. So we multiply the 2,400 by 20%, and that gives us 480. But again, the problem is that Kiko only uses the computer 75% for business. So we multiply it by 75%. So therefore, based on that, Kiko's maximum depreciation will be $360. So again, pretty much straightforward, and the computers, the tax software would determine this information to make it much easier. And then it also provides not just the current year depreciation, but even future year depreciation. So here we see here it's asking A, how much of the $240,000 purchase price is for Section 179 intangible assets, and part B is asking what amount can Devon deduct on his 2023 tax return as Section 179 intangibles as it relates to Section 197. So with Section 197, amortization is something that we realize is for intangible items. Depreciation, that's basically, tangible assets. So tangible represents things that we can perceive with our 5 senses. We can see it, we can touch it, etc. Intangible assets, however, are things that have value. However, we cannot, perceive them with our natural senses. So some examples of Section 197 is goodwill, going concern value, a license, a permit, a franchise, trademark, things of that nature. So it differs from depreciation simply because amortization is applied to intangible assets, whereas depreciation is for tangible, personal, or real property. So just keep that in mind. And one last thing as it relates to amortization, it doesn't include the half year or the mid-quarter convention. So just a few things to keep in mind. So here in this example, fixed assets, this is considered a tangible asset. So therefore, amortization will not apply. So for A, how much of the 240 is for Section 197 intangible assets? That will be the goodwill of 50,000 plus the covenant not to compete. So A, our correct answer is 70,000. B is asking, what amount can Devon deduct on his 2023 tax return as Section 197 intangible amortization? So one key thing about amortization is that essentially it is going to be deducted over a 15-year period, beginning with the month of acquisition. So here it lets us know that it was purchased on August 30th, 2023. So in order for us to factor it in, we would calculate it as follows, right? And in 15 years would essentially be 180 months. How do we know that? 15 times 12, that gives us 180 months. So what we would essentially do is 70,000 divided by, well, there's two ways. We can do 70,000 divided by 15. That's how much we would deduct each year. Then we would divide it by 12, et cetera, et cetera. But another way, think an easier way would be 70,000 because we see that this is not going to be a full year depreciation, so we can save a step. So 70,000 divided by 180 months gets us to 388, and we know that it was used for September, October, November, December, but they also factor in August, right? Even though it's a portion of the year. So August, September, October, November, December, 5 months. So therefore, the total depreciation will be 1,944. So again, even though it was purchased towards the ending of the month, under amortization rules, they do not have the half year or mid-quarter convention. So we would factor in August, September, October, November, and December, which represents 5 months. So I'll go over this calculation again quickly. Of the $240,000, only $70,000, the goodwill and the covenant to not compete, represent intangible assets. And we know that intangible assets are deducted over 15 years, and 15 years times 12 months per year gives us 180 months. So the total intangibles divided by 180, which means that we would be deducting $389 rounded per month. In the month of 2023, we had it for 5 months, August, September, October, November, December. So therefore, be $1,944. Here with this question, we look at business casualty gains or losses, and it's asking us to calculate the nature of Pravina's gain or loss as a result of this casualty. It states an office machine with a market value of $10,000 used by Pravina in her accounting business was completely destroyed by fire. The adjusted basis of the machine was $8,000. There was an original basis of $14,000 less the accumulated depreciation of $6,000. The machine was not insured. So the amount of business casualty or loss, it depends on whether the property was completely or partially destroyed. In the event that the business property is completely destroyed, then the loss is the tax basis of the property less any insurance reimbursement. If the business property was partially destroyed, then the loss is the insurance proceeds less the lesser of the adjusted basis at the time of the casualty, or the decrease in the property's fair market value that's associated with the casualty. As it relates to the business and investment property, they need to be identified as a capital asset. Is it a trade or business property that's subject to an allowance for depreciation, or is it ordinary income property? So based on this question that we see here, we essentially need to, factor in, we just mentioned, it was totally destroyed, completely destroyed by fire. So based on that, the basis, the amount of the business casualty is going to be the tax basis of the property, which in this case was $8,000. And in such case, this is going to be treated as a ordinary loss. All right. So obviously there's some nuances as it relates to business casualty loss, because there is a, distinct difference between business casualty loss and personal casualty loss. But in this case, it's pretty much straightforward. It was completely destroyed. So we write off the tax basis of the item. This brings us to our next question, where we look at what's called involuntary conversion. So 8 asks us to calculate Teresa's recognized gain if she elects to utilize the involuntary conversion provision. Teresa's manufacturing plant is destroyed by fire. The plant has an adjusted basis of $270,000, and Teresa receives insurance proceeds of $410,000 for the loss. Teresa reinvests $420,000 in a replacement plant within 2 years of receiving the insurance proceeds. So occasionally taxpayers, sometimes unfortunately, they're forced to have to get rid of a property, right? Sometimes there's circumstances that's basically just out of their control. Whenever there's an involuntary conversion, it's defined as the destruction of the taxpayer's property in whole or maybe in part. It could also be loss, or it could be theft, condemnation, requisition. Like there's various reasons why the individual can essentially lose the property, which we refer to as involuntary conversion. So at the election of the taxpayer and provided that certain conditions are met, the gain on an involuntary conversion of property, it may be deferred. So again, deferred means postpone. It means to delay. It does not mean that they're never going to recognize it. Just means not right now. The provision requires that the property needs to be replaced, and the basis of the replacement property reduced by the amount of the gain is going to be deferred. In order to qualify for the non-recognition of the gain, the taxpayer needs to obtain qualified replacement property, and the replacement property needs to be similar, or it has to be related service or use. And generally, the taxpayer has 2 years after the close of the tax year to obtain the replacement property. So in this example, we need to figure out, well, hey, what is Teresa's realized gain? So we calculate it as follows. We see that the insurance gave her $410,000. And then we know that the basis of the plan was $270,000. So we have a realized gain of $140,000. However, we see that the amount from the insurance proceeds, it was fully reinvested. Teresa reinvests $420,000 in a replacement plan within 2 years of receiving the insurance proceeds. So therefore, for A, nothing is going to be recognized. That $140,000 realized gain is going to be deferred. Now it's asking us, well, what is the basis in the property? So in order for us to calculate the basis for the replacement property is going to be equal to the cost of the replacement property, and let's just know here was $420,000 minus the realized gain, which is not recognized. So in this case, minus the $140,000 that is being deferred. Teresa's basis in the plan is $280,000. All right. So again, just to ensure that you understand how we calculated this for part A, she recognizes no gain. Why? Because the entire amount from insurance was used to replace the property. But here's how we determine the realized gain. $410,000, which is how much the insurance gave her, minus the adjusted basis of the property, which is $140,000. So this $140,000 is going to be deferred, postponed, delayed. Now, in order for us to determine the basis in the new property, it's the cost of the new property, which is $420,000, minus the deferred gain, which is this case is $140,000. So the basis in the plan is $280,000. All right, so this brings us to our last few questions. If land declines in value, it may be depreciated for tax purposes. This is false. Land cannot be depreciated for tax purposes. Very important to keep in mind. Let us say that you are, a client purchased a building, and a building costs $250,000 and the value of the land is $50,000. The depreciable basis for that building is the $250,000 minus the value of the land. Land can never be depreciated for tax purposes. Next, here we see it states depreciation is the process of allocating the cost of assets to expense over a period of years. This is true, right? Depreciation doesn't necessarily denote the loss of value. Depreciation is essentially an allocation of the cost to expense it over a period of time. And this brings us to our last question. If an asset's actual useful life is longer than the assigned recovery period, the MACRS tables cannot be used. False, right? This is just an estimation. So the MACRS tables, they are used even if the asset's useful life is longer than the assigned recovery period. So a great example of that would be cars, right? Cars are essentially given a 5-year period. Cars can last 20 years, 30 years, depending on how good you take care of the car. So this is false. If an asset's useful life is longer than the assigned recovery period, not a problem. Just note that after year 4, year 7, whatever year is going to be used for the property, if it's 3-year, 5-year, 7, 10, 15, 20, after the end of the period, just know that it's fully depreciated, but the asset can still be used in the business. So that brings us to the end of our questions for Chapter 8, Depreciation and Sale of Business Property.